Welcome back to our channel where we dive deep into the world of finance and break down the hottest stocks on the market. Today, we're going to talk about a company that's been making waves in the financial software sector, Intuit Inc. Now, let's get into the numbers and see why this stock has been catching everyone's attention. First up, let's talk about the price-to-earnings ratio, or P ratio. The P ratio gives us an idea of what the market is willing to pay today for a stock based on its past or future earnings. For Intuit, the trailing 12 months P is 39.82, which means investors are willing to pay almost 40 times the company's earnings. Over the past 5 years, the average P has been around 41.37. So, it's been relatively stable in terms of valuation. Looking forward, the forward P ratio is 34.62, suggesting that analysts expect Intuit's earnings to grow, and the stock might be a bit cheaper based on future earnings. Now, let's dive into the PG ratio, which is the P ratio divided by the growth rate of its earnings. A PG ratio below 1 is usually considered undervalued, but Intuit's PG is 2.77. This higher PG indicates that the stock might be overvalued based on its expected growth. But here's something cool: insider ownership at Intuit is 2.85%. This is a good sign because it means the people who know the company best, its executives and directors, have skin in the game. Now, let's talk about profitability. Intuit boasts a return on equity of 16.92%, return on assets of 9.74%, and a return on invested capital of 13.14%. These numbers are quite strong, showing that the company is effectively using its resources to generate profits. Earnings per share or EPS is a critical metric for understanding a company's profitability. Intuit's EPS is currently 16.63. But what's really impressive is their expected EPS growth rate for the next 5 years, which is 14.39%. And get this, over the past 9 years, Intuit's EPS has seen a very positive evolution, with a compound annual growth rate of 18.19%. That's some solid growth right there. Speaking of growth, let's look at free cash flow per share. Over the last 9 years, Intuit has also seen a very positive evolution here, with a CAGR of 15.92%. This free cash flow is crucial because it shows how much cash the company has after maintaining and expanding its asset base. Dividends, anyone? Intuit's current dividend yield is 0.55%, which might seem modest, but the company has been growing its dividend at a compound annual growth rate of 16.74% over the last decade. Not bad at all. Operating margin and profit margin are also healthy at 23% and 18.35%, respectively. These margins indicate that Intuit is not only generating substantial revenue but also keeping a good chunk of it as profit. Now, let's talk about revenue and earnings. Over the last 8 years, Intuit has seen very positive growth in both revenue and earnings. This growth has been reflected in their stock price, which has outperformed the Vanguard S&P 500 ETF, VO, over the last 5 years. Debt-wise, Intuit's debt-to-EBITDA ratio is 1.53, and debt-to-free cash flow ratio is 1.43. These ratios suggest that Intuit is managing its debt quite well relative to its earnings and cash flow. And check this out, the average price return of Intuit over the last 52 weeks is a whopping 47.23%. With a market cap of $187.65 billion, this company is a giant in its sector. Finally, analysts are predicting that Intuit's stock price will hit $696.62 in the next 12 months, which represents an upside of 5.19% from its current price of $662.25. But here's where it gets interesting. Based on my calculations, the fair value of Intuit Incorporated is $582.72. This suggests that the stock might be overvalued at the moment. So, there you have it. Intuit Incorporated is a company with solid growth, strong financials, and a bright future, but it's important to keep an eye on its valuation. What do you think? Is Intuit a good buy right now, or should we wait for a better price? Drop your thoughts in the comments below. Don't forget to like, subscribe, and hit that notification bell so you don't miss out on any of our future deep dives. Thanks for watching, and we'll see you in the next video.